Hi, I'm Elizabeth Michalek, and I'm here with Dave Young. Dave, over the last few months, we've seen a lot of volatility in the market. What do you feel is driving that?
Well, as you mentioned, the volatility has been extreme ever since about the middle of July. And we measure that volatility using the VIX. And usually when you get up to a level of 45 on the VIX, that's about as high as it goes normally. And we've been there several times in the last couple months. It's really been crazy. The market started selling off back in about July 23rd, I think. And as the U.S. was getting their debt rating lowered because they went past some deficit action. And when that happened, the market started selling off. And then about the time the market was getting its feet under all the Europe financial mess started showing up, and so it sold off a lot more. And then ever since then, it actually came down about 2,300 points. Then it bounced back up 1,000 points, back down 1,000 points, back up 1,000 points, back down 1,000 points in a matter of days. And for example, a couple weeks ago, we were right about to break through the lows, and since then, the market's reversed and come up over 1,000 points again. So it's really a manic depressive kind of a situation where you're going from extreme lows to extreme highs. As far as what's causing that is there's a real indecision in which way the markets are going. On the one hand, you've got corporations whose earnings have increased every quarter for the last 8 quarters. They've been beating expectations, knocking out of the park. These same corporations are holding about $2 trillion in cash that they're just sitting on from the profits that they've generated. And so on the one hand, when you just look at the corporations, and essentially corporate earnings drive stock prices, so stocks will go up normally as corporate earnings go up.
Right.
Well, so on the plus side, that should be pushing stock prices up. And that's what has happened is every time the market gets smashed down, the current earnings and the current stock undervaluations cause the stocks to bounce back up. So in the big picture, you've got these macro issues which are big and scary, which are the financial mess in Europe, the financial mess in the United States. Those are overridingly negative, which is causing the market to swing down. And then you've got the corporations themselves, which are actually doing extremely well, which is causing the market to come back up. And there's such a disconnect between those two that you'll get a big swing down, a big swing up, a big swing down, a big swing up. Usually those two would be more in sync, and so you wouldn't see the level of volatility normally, but that's kind of what you've got going on right now.
Okay, so what is it that investors should do during a time like this?
Well, when markets get this volatile, I mean, normally you can adjust to volatility, but when they get this volatile, usually you're best to essentially just hold tight, because if the market goes down and you come out and then the market bounces up back and you jump back in, and then the market swings down and you jump back out, when it's this extreme, you pretty much are forced to just sit tight. So for example, coming into, as the market started slowing down, we were about 80% invested, about 20% cash. And because the swings have been so extreme back and forth in this range, we pretty well held to that 80-20. And normally what we'll do is, if the market hits the low and continues to break down, then we'll add more cash to dampen it. And if the market breaks up, then we'll start to move back into the market to capitalize on it. But you can't make any sense out of a market doing this.
Right.
And so we've got to see a trend, and we'll see a trend once it starts to break one way or the other.
Great. Thanks, Dave.
Thanks.